China's banks are insolvent as they run out of cash. I'm your host, Steven Van Metre, and thanks for joining me today. And things in China continue to go from bad to worse as several banks are now freezing accounts and preventing depositors from accessing their funds, and a sign that they've run out of cash. Let's pick this story up where we headline, "The Chinese depositors left in the dark as 3 local banks freeze deposits." And 3 banks in China's central Henan to Province have frozen at least $178 million in deposits, offering scant information on why or for how long, leaving firms unable to pay workers and individuals locked out of savings. These 3 banks froze all deposits on April 18th, with all 3 telling customers that they were upgrading the internal systems. The banks have not issued any communication on the matter since, according to depositors. Now, I want you to think back. If on April 18th, imagine if your bank said you could not access any of your money, and when you asked why, they said, don't worry, we're just upgrading our internal systems, and I'm sure it'll be fine soon. And more than a month later, you still cannot access your money, and the bank still has no reason why. And that's a sign not of a system upgrade, but of a bank that's insolvent. Let's continue on. While normally small, China's numerous local banks have outsized significance because they lend to small and mid-sized businesses firms, so their activity can be an indicator of the health of the economy, the world's second biggest after the United States. And this is something we talk about on the show all the time, is that problems always start small. They never start big and work their way down. They start small, and now we're seeing cracks in the small banks, and that was only telling us where this is going. And we saw the same, in the Evergrande story, in the property market. It started out and small, and now it's impacting some of the biggest firms that nobody thought would ever have problems. And here we are, back to the banking problems. As bank earnings and asset quality are widely expected to deteriorate due to reduced business activity brought about by strict COVID-19 containment measures, raising the prospect of economic contraction in the second quarter of the year. Depositors of the 3 banks told Reuters that they'd been communicating with each other via a messaging app called WeChat about how to retrieve funds. Some posted screenshots of frozen accounts and shared conversation with bank staff. Some posted videos of protests outside bank branches, while others said they've traveled to the bank's headquarters in search of an explanation, only to be turned away by police. Now again, can you imagine being in their shoes where your accounts are frozen for more than a month? You go to the bank to get an answer, and the police send you away. That's not a sign of a healthy banking system, but of one that's out of cash. Let's continue on, because now we're seeing other headlines that China's big 6 banks meet first quarter profit forecasts. So you would get the impression that from the big banks, there's no problem. Of course, this is going to be an issue with the small and mid-sized banks, but COVID-led slowdown poses higher bad loan risk. Now, something that's going to happen here in the U.S. is when the recession gets into full swing, we're not going to see big problems with the big banks because they had the privilege to take on the best loans with the best customers, with the people with the best credit ratings. And what they did was push all the bad loans, the bad customers, the bad credit risk down to small and mid-sized banks. And that's where we're going to see same problems here in the U.S. when our time comes. Not far off, but it will happen. China's loans tumble as coronavirus lockdowns hold back credit growth. And again, no surprise with these headlines is when people are locked up and they can't go anywhere, they can't do anything. Well, not only can they not go out and borrow money to spend because, they can't go anywhere, but how do you start servicing your existing debt when you can't even access your bank accounts? And of course, that means more bad things are coming for China's banking system. China banks cut key rate by record to boost ailing economy as the central bank steps in to do some damage control. And Chinese banks cut key interest rate for long-term loans by a record amount, a move that would reduce mortgage costs and may help counter weak loan demand caused by a property slump and COVID lockdowns. The cut is a significant move to business loan demand as customers and business confidence have been battered by COVID lockdowns, no surprise, and a downturn in the property sector that's seen a string of deeper defaults and falling home prices. The lower rate will be applied to new mortgages immediately, while existing mortgages won't be repriced until next year at the earliest, giving us an indication that there's a lot of adjustable rate mortgages in China, whereas here in the U.S., we don't really see that as much, although there's a beginning demand for those. Of course, it's interesting as rates rise that people choose an adjustable rate mortgage. Could play out for them if rates fall, could go badly if rates rise. Let's continue on, because the property slump there is getting worse, as we've talked about, as China's home sales decline faster as in April, given that people are stuck at home and cannot go shopping under their COVID lockdowns, and that's going to cause a huge loss of confidence. And even before these two cuts, some banks were already lowering the cost for new mortgages, with lenders in more than 100 cities cutting mortgage rates by 20 to 60 basis points since March, according to PBOC officials. In addition, the central bank has told banks to lend more. Regulators have relaxed some rules controlling finance for property developers, and dozens of cities across China have loosened home purchase policies. Now, something that's interesting here is you'll see that the banks are actually lowering rates. Now, here in the U.S., with the Fed raising rates and tightening monetary policy, the belief is rates have to go up. It's something we talk about every week, is how demand for loans is falling, and eventually banks are going to have to drive rates down, because again, what is their product? It's not widgets, it's not car washes, it's lending. And if people don't come in and borrow money because rates are too high, well, banks have to bring rates down. And that's why we at least see in the US rates fall despite the Fed raising rates. And now you're seeing the same thing happen in China. However, that hasn't been enough to turn around demand. Medium and long-term household loans, a proxy for mortgages, contracted by 31 billion yuan in April, meaning more people repaid loans than took out new loans. And that might be part of the explanation of what's happening with these small banks, because they need people to borrow new money, to create money into the financial system. That's how debt-based systems work. You need a constant supply of new debt to pay, because as old debt is paid off, money is destroyed. So you need new loans to create new money in the system. And now we're maybe getting a real truth of what's going on inside China's banks. And you can see slumping mortgages as China's proxy for home mortgage contracted again in April. Here in black is actually tumbling, and that is terrible. That back in 2020, and now we see, of course, 2021, 2020, 2019 all headed down, but look at the beginning of this year, it's terrible. However, the question remains whether the rate cut will be enough to stimulate the sector as COVID lockdowns continue to damage people's income, prospects, and confidence in the sector. It is unlikely to see the property sector become the main growth engine again to lift growth rates. We expect only moderate rebound from mortgage rate cuts as the property sector still faces headwinds like stringent regulations, the moderate to tight liquidity conditions, and dampened consumer demand due to COVID outbreaks. Now, things in China obviously are a mess, and if you're concerned about your portfolio going illiquid when things blow up in China, well, you shouldn't be. I'll put a link up here in the corner, Portfolio Shield, and down in the corner and down in the description below. Be sure to check out how it did during the great financial crisis. And of course, you'll see why is so great. Let's continue on, because China's central bank is back as regulators urge banks to boost lending, as banks should accelerate the delivery of approved loans. Just crank them through. Don't worry if they're qualified or not. As the People's Bank of China officials met with 24 major financial institutions Monday to discuss credit conditions and work, the central bank said in a statement on Tuesday. The meeting called on banks to accelerate the delivery of approved loans and also maintain the stable growth of property loans, according to the statement. And see, now you get it, right? So the problem is people are paying back loans, money is being destroyed, and not enough new loans are being created. So what does the central bank come in and say? Look, just crank those things out, just sign off, get those loans funded, because the system is desperate for money. Major financial institutions need to shoulder the responsibilities to make use of all resources to effectively connect with credit demand and strengthen policy transmission. It added that banks should focus on key areas such as small businesses, green projects, technology innovation, energy supply, and infrastructure, and possibly anybody who actually just wants a loan. And as you can see, his credit is slumping as new loans plunged to the lowest level since 2017 here in April, obviously due to lockdowns and lack of demand and a lack of confidence in the system. The PBOC also vowed to guide banks to go all out to increase loans, according to a separate statement published on Tuesday about a meeting discussing credit that was held Monday. The central bank also said it would support lenders to lower financing costs as well as step up for small businesses in order to stabilize the economy and jobs. And now you can get a picture of just how bad things in China are. And when you see 3 small banks stop providing money to depositors and freezing accounts, where do you think this is going to go? Remember, where there's one cockroach, or in this case 3, Well, there's probably more coming, just like China's property market. And as of right now, it looks like China's going to be at the epicenter of the next great financial crisis. And that's not a good thing. I'm Steve Van Metre. Thanks for being fans. Thanks for watching. Bye now.